Hey everyone, welcome back to Corporate Decoder, the place where we unpack those dense corporate reports to find the juicy bits. Get ready, because Pineapple Financial Inc.'s latest filing is a wild ride from mortgage tech to digital assets that might just make your head spin. So, are they the next big thing or just trying too hard to play catch? Up in the digital world, let's dive in and find out. Alright, so we are looking at Pineapple Financial Incorporated, a Canadian company that started in mortgages and has recently gone all in on a digital asset strategy. They are essentially a mortgage technology and brokerage company connecting agents, brokers, and consumers. But here is the kicker, they've also decided to dive headfirst into digital assets, specifically NJ tokens, as part of their corporate treasury strategy. Think of it like a mortgage broker deciding to hold Bitcoin on their balance sheet. It is a bold move. And the filing is laying out all the details of this pivot. Right now, they're offering a lot of common shares for sale. These aren't new shares they are issuing to raise money. Instead, existing shareholders called selling stockholders are selling their shares. This usually happens when a private company goes public, or in this case is preparing to have more shares available for trading. They're looking to sell over 25 million shares. This is primarily from people who bought something called subscription receipts, which are now being exchanged for these shares. Let's talk about the money, because that is where the story really gets interesting. For the year ended the 31st of August 2025, their total revenue was just under $3 million, a solid increase of about 11% compared to the previous year. This growth seems to be driven by more mortgages being processed and their technology platform called Pineapple Plus, which agents use. It is good to see their core business is growing, especially considering the housing market has been a bit bumpy. Now, diving a bit deeper into their mortgage business, they originated almost $1.6 billion in mortgages in the year ending August 2025. That is up from about $1.5 billion the year before. While this sounds like a lot, and it is important to remember this is their main business before they started playing with digital assets. Their growth here is steady, showing resilience in a challenging real estate market, likely boosted by higher volumes of renewals and refinances. But here is where things get a little more complicated. Despite the revenue growth, Pineapple Financial Inc. is still losing money. For the year ending August 2025, their net loss was about $3.6 million, a slight improvement from a loss of over $4 million the year before. So while they're making more money, they are still spending more than they earn. This is a common story for companies growing and investing in new areas, but it begs the question, can they keep it up? Their loss from operations shows a similar trend, actually improving by nearly 23% compared to the prior year, landing at about $2.9 million. This improvement is thanks to that revenue increase we just talked about, but also because they've managed to cut down on some operating expenses like advertising and marketing, and also salaries, wages, and benefits. It seems like they are trying to streamline things to become more efficient. Speaking of salaries, wages, and benefits, this is an area where they actually cut back significantly, decreasing by about 32%. This indicates some restructuring or cost saving measures were put in place, possibly by letting go of some staff or optimizing their workforce when a company is cutting down on its people costs while trying to grow. It always makes you wonder about the sustainability of that growth. On the flip side, their interest expense and bank charges more than doubled, jumping by almost 260%. This is a pretty big jump, and it is a clear sign that they've taken on more debt or loans, likely to fund their new ventures or cover operating costs. Borrowing at higher interest rates, as they mention, is never ideal, especially when you are already losing money. Now, this is interesting. For the year ending August 2025, they reported over $235,000 in share-based compensation. This means they've been giving out stock options or restricted stock units to their employees and executives. This is a common way for companies, especially newer ones, to attract and retain talent, aligning their interests with the company's long-term success, but it is also a cost and another factor contributing to their overall expenses. If we look at their overall financial health, it is a bit concerning. As of August 2025, they have an accumulated deficit of over $13 million. Think of deficit as a massive pile of losses that have built up over time. They also have a working capital deficit, meaning their short-term debts are more than their short-term assets. This is a big reason why there is substantial doubt about their ability to continue as a going concern, which is a fancy way of saying, can they stay in business? And their cash flow from operations confirms this. They used over $946,000 in cash for operations in the year ending August 2025. That is actually better than the year before, when they used over $1.7 million, but it still means they are burning through cash just to keep the lights on. Where are they getting their cash then? Well, financing activities brought in over $3.4 million in 2025, up from about $2.9 million in 2024. This cash is coming from new borrowings, which is how they are bridging the gap from their operating losses. It is a cycle, they lose money, so they borrow money to stay afloat and invest, which then leads to more interest expenses. Now, let's talk about risks, because this company is piling them high. Their entire strategy seems to revolve around the volatile world of digital assets, particularly NJ tokens. They openly admit that the price of these digital assets is extremely volatile and could drastically affect their business and share price. It is like they're betting the farm on these tokens, and if the market crashes, they could be in serious trouble. There is also a risk that their stock price won't reflect the actual value of their digital asset holdings. This means investors could be buying stock that is worth less than the underlying assets. They could also have trouble raising more money if their stock price is too low. And this shift to NJ tokens isn't just a simple investment, it requires big changes in how they run the company, bringing new operational, technical, and compliance challenges. They are exposed to significant operational risks, and any disruptions in the injective ecosystem could hurt them badly. The legal and regulatory landscape for digital assets is still very unclear, and new rules or interpretations could come out at any time, potentially harming their business. They could be classified as a security or commodity, leading to a whole new world of compliance costs or even forcing them to shut down parts of their operations. It is a very uncertain path. Let's not forget their original business mortgages. They are heavily reliant on the health of the Canadian real estate market. If the economy slows down, interest rates go up, or housing prices drop, it directly impacts their ability to originate mortgages, and therefore their revenue. This is a fundamental risk that is always present in their business. And to top it all off, they admit they need more money to keep growing and competing. But here is the worry, they might not be able to get that money. Or if they do, it might be on unfavorable terms, meaning existing shareholders could have their ownership diluted. This is a classic challenge for companies that are burning cash and need to fund ambitious plans. Looking at their stock, it has already been quite volatile. The filing warns that their stock price could zoom up or plummet down based on all sorts of things, from whether they hit their targets to general economic news. So investing in their stock is definitely not for the faint of heart. Who owns a big chunk of the company? Well, looking at the principal shareholders, we see that their CEO Shubha Dasgupta and President Kendall Marin hold significant stakes. Outside investors like Polar Multi-Strategy Master Fund and White Lion Capital LLC, along with the Injective Foundation, also appear to be major players. It is clear that a few key investors and company insiders have a lot riding on this company's success. This section highlights the investors who are selling their shares through this offering, but remember, Pineapple Financial Incorporated isn't getting any of that money. It is all going to the selling stockholders. Let's talk about the shares themselves. Holders of these common shares get to vote at meetings and are entitled to any dividends the company might decide to pay. But here is the key takeaway from this section. The company doesn't plan to pay any dividends anytime soon, so don't expect any regular income from holding these shares. This section basically explains how the selling stockholders will get rid of their shares. They can sell them through brokers in private deals or pretty much any way allowed by law. The company isn't involved in the actual selling process or benefiting from it. Okay, let's look at the core financial health. As of the 31st of August 2025, their total assets were about $5.4 million, which is up from $4 million the year before. This increase is largely due to a jump in their cash balance from $580,000 to over $2.1 million. That is a pretty significant increase in cash, which is good, especially given their uncertain future. On the other side of the balance sheet, their liabilities have also grown quite a bit, to over $4.5 million from just under $2.75 million a year ago. A big chunk of this increase comes from accounts payable and accrued liabilities, which went from about $1.1 million to just over $2.1 million. This means they owe more money to their suppliers and for expenses, which is not ideal when you are trying to manage cash flow. And as we saw before, that accumulated deficit has ballooned to nearly $13.4 million, a big jump from $9.7 million a year earlier. This highlights the consistent losses the company has been facing. Here we see the income statement. As mentioned, revenue is up, but so is their net loss. The total expenses in 2025 were just under $6 million, a decrease from about $6.5 million last year. So they've managed to reduce spending, but not enough to offset the growth in their net loss, which still stands at $3.6 million. And for the shareholders, this translates to a loss of $5.31 per S-share in 2025, compared to a loss of $11.46 per S-share in 2024. While the loss per S-share has improved, it is still a significant loss for each share owned. Looking at cash flow, their used $946,000 for operations in 2025, which is an improvement from using $1.7 million in 2024, but they are still burning cash. Their financing activities brought in over $3.4 million, primarily from borrowings, helping them to offset the cash used in operations and investing activities. Their cash balance did increase significantly, which provides some breathing room. It is important to note that these financial statements are prepared according to United States Generally Accepted Accounting Principles, or US GAAP. This is standard for companies reporting to the SEC. This is a really important note from the auditors. They are saying there is substantial doubt about its ability to continue as a going concern. This means, based on their losses and cash flow, there is a real question mark over whether the company can survive the next 12 months without getting more funding or making significant changes. This is a major red flag for potential investors. They have a small investment in another private company, valued at just under $10,000. This is such a tiny part of their overall finances that it is barely worth mentioning, other than to say it is not a significant driver of their business. Their intangible assets, mainly software development, are valued at about $2.5 million. They amortize these over 7 years, meaning they spread the cost of developing that software over its useful life. This is standard practice for tech-focused companies. Let's revisit revenue. They break it down into a few streams. The biggest by far, about 95%, comes from commissions from lenders. Then there is subscription revenue, underwriting fees, and insurance commissions. But the heavy reliance on lender commissions means they are still tied to the mortgage market's ups and downs. They're also growing their insurance business, Pineapple Insurance Incorporated. It is still quite small, bringing in under $200,000 in revenue in 2025, but it is a new revenue stream they're developing. They are acting as an agent, connecting customers with insurance carriers and earning commissions. They also have sponsorship revenue where lenders pay to promote their brands at company events. This is bringing in a bit of cash, currently over $220,000, which is a decent start. Here is a detail that stands out. They took out unsecured loans from their own directors, totaling over $600,000. These loans carry a hefty 12% interest rate and are repayable in December 2025. While it is good they can get financing, borrowing from insiders at such a high rate can sometimes signal desperation for cash. They also had a convertible loan of $300,000 that carried an 8% interest rate. The investor had the option to convert this loan into company shares, which they eventually did. This type of instrument is often used by companies that are struggling to get traditional financing. Despite their losses, they have some deferred tax assets, mostly from operating tax losses carried forward, which expire in 2045. They also have a significant valuation allowance, essentially an offset against these deferred tax assets because they're not sure they'll be able to use them. This means they're not benefiting from these losses for tax purposes right now. Now, for the really forward-looking stuff, what happened after August 2025? They've been very busy. They closed a huge private placement, raising about $100 million in cash and NJ tokens. They've drawn down $11.8 million on a $15 million credit facility, also investing in NJ tokens. And they have an equity line of credit for up to $250 million with White Lion Capital Incorporated. It is clear they are aggressively pursuing funding, much of it tied to their digital asset strategy. This lists their foundational legal documents, like their articles of incorporation and bylaws. While not exciting, these are the rules of the game for how the company is structured and operates. They have outstanding warrants, which are basically options to buy shares at a certain price. The Meteora warrant, for instance, is a big one, and it is tied to compensating a consultant. These warrants can be a source of future dilution for existing shareholders if they are exercised. This marks the major agreement for their big private placement involving subscription receipts and the NJ tokens. It details the terms and conditions of that massive fundraising effort. They have a policy in place to guide directors and employees on trading company stock. This is a standard measure to prevent unfair trading practices. This policy allows the company to recover certain incentive-based compensation from executives if their financial statements need to be restated due to an error. It is a measure to ensure accountability. This outlines the responsibilities of their audit committee, which is responsible for overseeing the company's financial reporting and internal controls. This is crucial for maintaining investor confidence. This document describes how the compensation committee determines pay for executives and directors. It is all about aligning incentives and rewarding performance. This committee focuses on selecting new board members and ensuring good corporate governance practices. It is all about keeping the company running ethically and effectively. Looking at executive pay, the top earners like Shubha Dasgupta and Kendall Marin took home around $224,000 each in 2025, including salary and stock awards. Sarfraz Habib, the CFO, earned about $149,000. While these numbers might seem high or low depending on how you look at it, they are typical for executives in growing companies, especially when stock options are involved. As of August 2025, their executives and directors had a significant number of stock options and restricted stock units. Some options are exercisable at a very low price, like $1.3, giving them a nice payday if the stock price rises substantially. These awards are a big part of their compensation strategy. Going back to the shares as of December 2025, there were about 1.3 million common shares outstanding. This number has grown significantly, especially with the recent equity issuances and warrant exercises. The principal shareholders table shows who owns the most stock. It is a mix of company insiders like the CEO and president, strategic investors, and some investment funds. This concentration of ownership means that any decisions made by these large holders can heavily influence the company's stock price. This table lists all the entities and individuals who are selling shares. It is a long list reflecting the diverse group of investors who participated in the private placements and are now looking to sell. This explains how the selling stockholders will actually get their shares into the market. They can use brokers, private sales, or other methods to sell their shares. The key point is that Pineapple Financial Incorporated itself is not selling any shares here and therefore not receiving any proceeds. Holder of these common shares have voting rights and are entitled to any dividends. However, the company has not paid and does not plan to pay dividends in the foreseeable future, so any return for shareholders will likely come from stock price appreciation. They have a few outstanding warrants which give holders the right to buy shares at a specific price. These warrants, if exercised, could lead to more shares being issued, which could dilute the value of existing shares. They have lease liabilities on their books related to their office spaces. These are long-term commitments, and as of August 2025, the amount due over the next 5 years is substantial, around $814,000. Despite their losses, they carry significant deferred tax assets, mostly from tax losses. However, they have a large valuation allowance offsetting these, meaning they are not currently benefiting from these potential tax savings. This is common for companies that are not yet profitable. This section is full of important recent developments. The $100 million private placement is a huge deal, especially the part involving NJ tokens. This is the core of their new digital asset strategy. They've also secured a $15 million revolving credit facility and have that massive equity line of credit. These are all moves to secure capital, but they come with significant risks associated with digital assets. This agreement outlines a significant revolving credit facility of up to $15 million. The fact that a large portion has already been drawn down and invested in NJ tokens shows how serious they are about this digital asset strategy. The collateral is tied to their digital asset holdings, meaning if those assets lose value, they could be in a lot of trouble. So, what is the verdict on Pineapple Financial Incorporated? They're playing a high-stakes game. Their core mortgage business shows steady growth, which is a positive. However, they are still losing money and heavily reliant on external financing. The real gamble seems to be their aggressive dive into digital assets, specifically NJ tokens. This strategy carries immense regulatory, technical, and market risks, as they themselves admit. While it could lead to massive gains if successful, the downside is equally significant, potentially jeopardizing their ability to continue as a going concern. They're trying to be a tech innovator in mortgages while also becoming a digital asset player. It is a complex strategy that will require flawless execution and a lot of luck to succeed. Now, looking at these numbers more broadly, Pineapple Financial Incorporated is trying to pivot from a traditional mortgage brokerage company to something more dynamic, embracing both technology and the speculative world of digital assets. Their debt levels are rising and their core business, while growing, isn't yet profitable enough to sustain their ambitions. The biggest question mark is their digital asset treasury strategy. If NG tokens perform well and they can navigate the regulatory minefield, they might just pull it off, but the risks are enormous and the path to profitability is far from clear. It is a high risk, potentially high reward situation, but right now, the risks seem to heavily outweigh the potential rewards. Alright, that is our breakdown of Pineapple Financial Incorporated's latest filing. What is your take on this bold digital asset strategy and their core mortgage business? Do you think they'll succeed, or is this a recipe for disaster? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more corporate deep dives. And hey, if you want to connect with other finance enthusiasts and get more exclusive content, check out our Discord community. Linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.